All right, guys, welcome back. Bang on time today. What we're going to do, chart patterns this afternoon, so slight advancement of candlesticks. I'm sure a few patterns will come up, but we will talk through them. I've got quite a lot of, rather than me stand here drawing patterns and telling you what to do, I have quite a lot of different examples of where they've worked, where they've not worked. So I think more often the important bit is when they don't work. It's all very nice and easy to find a pattern and go, yeah, that's a beauty, that's exactly what you expect. But we'll have a look at a few that perhaps require a little bit more interpretation, perhaps require a little bit of understanding of context, and ones that just don't work. So we'll have a look at that and where you would want to be giving up on it, where you perhaps wouldn't want to be giving up on it. So let's go onwards. The whole point is this is what gives you that context behind the candlestick. Yeah, if you've got your individual candlestick that says do one thing or another, the chart pattern overall is going to tell you whether actually that's a good idea or not. Good thing with patterns, you get a clear entry, you get a reasonably clear stop, and you get a target. Whether you want to adhere to the target is up to you. The way I see it, yes, a pattern might have a target. Not everyone's looking at the same pattern as you. So if you've got a certain pattern playing out and your target is 120 ticks, but there is a major level 100 ticks away, I would suspect the market is probably going to pay more attention to that level than the fact that the target's an extra 20 ticks. If it breaks the major level, the target, yes, might be another 20 ticks. It's probably going to go quite a lot further than that. So for me, the targets are more just a guide of an area that I should be looking for an exit point in, rather than necessarily saying, right, well, it must go there. I'm staying till it does, because that can often cause you trouble in that the market then comes back. You say, no, it's not gone to target, but there's so many other reasons, and by that point there could be new patterns developing that are negating the one that you're trying to trade. So yes, target's very useful. Yes, at least it gives you a sense of what you should be expecting, but be aware with those targets of getting too married to the target and trying to sit until it reaches that very final tick. So we'll talk about that in a little bit. As always, time frames are important. Bigger time frames matter. However, when volatility gets high, as it did last week, shorter time frame charts, shorter time frame patterns start working nicely. Ultimately, you could almost look at this in terms of, rather than time frame, range. If you've got, say, an hourly pattern that gives you a 100 tick target, then that's showing up on an hourly chart, and the current ranges are sort of saying, yeah, 100 ticks for a couple of hour move is around about acceptable. If you then get a particularly high volatility period and you've got a 5-minute chart that is giving you a target of 100 ticks, well, you can start thinking to yourself, actually, that's quite realistic. Yeah, if your market is now doing 400 ticks range a day, then that 5-minute setup becomes a little bit more acceptable. So almost it's the larger range setups that are perhaps better and more likely to work out than looking at a smaller range setup where you're looking for a flag break, for example, and a run of 10 ticks. It may well work out, but it's a less important setup, and one that is perhaps going to get knocked over by some other factors, perhaps on a slightly larger time frame chart. Where I do like the shorter time frame setups is setting you up for a larger setup, so sort of a pattern within a pattern type trade. It's a really nice example of it on the FTSE this morning, which I'll bring in for you just now. This is just on a 1 minute. What you got in the FTSE this morning, let's make this go wider. go massive. That was not what I was looking for. What we had in the FTSE basically is we had a level at 71.09. Now, I was expecting that level to break, push to the upside. But what you need is a little bit, basically the pattern on the larger time frame was a drop and then a move back to the same level. So I'm looking for this level to break to the upside. So what you can do is then start looking at your shorter term sort of patterns to try and find a way to get into this. Now for me, what I was looking at, and like I said, this is very short term. So on a 1 minute, just here, you had a range. It was a very tight range. The range was 70.97 to 71.05. Break the range, move back into it. That for me was the opportunity to get long looking for the break of 09s rather than wait for it to get to 09s and then try and buy the break and see if we continue. The move back into this range here and the move above 05s was the chance to have a go at buying that. So that small pattern was giving me the opportunity to get long for that bigger time frame pattern. Yeah, in terms of what you'd expect from this, we'll come on to ranges in a bit, but ultimately it's a range break and the range is 8 ticks. You should only be expecting an 8 tick move to the upside. But the fact that that 8 tick move to the upside takes me through 09s was meaning that my target's not going to be 8, it's going to be further than that. In the end, we went up 10, pulled all the way back towards the 04, 05 area, and then we did go again and we got up towards the main target, which for me was 33s. So we did work the trade out. We also had got another secondary wedge there as well, or sorry, range bound bit of trade, which you could have played that break a second time as well. So it's using those shorter time frame setups to give you those longer time frame plays. So that's where I think the short time frame is very important. A bit like, you know, using a 5-minute candle to get you in preemptively for a much larger, say 15-minute or hourly type setup. Those smaller patterns are what gets you in on those bigger trades. You can perceive a pattern to have perhaps a little bit more logic to it. The pattern's still always there, whereas if you are not using a candlestick chart, you don't see that. You know, you can't see a hanging man candle if you're using a point and figure chart, footprint chart, profile, whatever. Whereas pattern-wise, if you're using a footprint chart, if you're using profile perhaps slightly off, but say point and figure, you're still going to see that pattern develop and the pattern is still the same on whatever chart. Also, the other big part of it is patterns come from some kind of positioning. It's come from people's attempt to do one thing and then either failure or success in that. So that positioning then can help you and tell you what is actually going to happen next. Ultimately, in my opinion, a chart is just merely a picture of a group's opinion of something, and that changes constantly. But that picture of sort of everyone's thoughts on where the market should go follows certain patterns, which then everyone can understand the pattern, see that it then starts to move in one way, and then everyone's opinion changes. That's where you get this sort of like flow of markets that sort of move from not much going on to a point where everyone goes, actually, now something is going on. So that's the way I see it, that ultimately it is just everyone's thoughts together, and that's why there is a bit more logic to it, because everyone thinks together and everyone can perceive things in very much the same way. All right, so let's go and have a look at some patterns. Flags and pennants. The key thing with a flag and a pennant and the difference between them and a wedge is the fact that you need a pole either to the downside or to the upside. Now with a flag, you're expecting a bounce like this. Often you might be able to get almost a trend on the upside, so you get a sort of channel move higher. what's happening here is sellers are getting sort of pushed back higher. They can't get the break lower. However, the problem here is that every time buyers take it through a new high, they get turned back over. So you're in this sort of slight impasse almost, that until you get a break one way or another, you're stuck. But the fact that the buyers consistently are stopping the selling but not managing to get continuation creates a greater likelihood that we are going to fall like that. Now, in terms of how you're going to play this, you want to be selling the break of the actual line. So that's where you want to be selling it as it breaks. Two ways of looking at this. You're either looking for a candle close below here to sell, or you're going to go with momentum, go with a price action on that break of trend. The difficulty with any flag is that progressively your stop gets further and further and further away. However, because it's a breakout, you would expect it to actually move quite quickly in your favour. If it's not starting to come down and take out these lows, then it's giving you a little bit of a clue that this may not be working. So that's your first sort of clue if a flag's not going to work, that it won't start taking these lows. For me, the point where I feel that, yeah, this flag is going to work out, that we are going to get a move, is when we actually get through the low of the initial move down. That's the point that I feel that, yes, now anyone playing this flag is going to decide that actually this is on. You know, it's going to go, because you will get people wait for it. You'll get people wait until you break this low, because ultimately, until this low's gone, the trend hasn't continued lower. So that becomes the sort of next trigger point that says, right, now we're going for it. Now it's definitely on. Some rules, and I do think with a flag, as I'll show you in a couple of examples in a minute, is open to a lot of sort of interpretation, requires a fair bit of sort of art rather than science to it. Now, technically, if you get more than 50% of the way back up the pole, that flag is invalid and should not work anymore. However, for me, if we trend up here, break 50%, come back down and then break the flag, I don't really see how that's not in play still. Ultimately, you have broken the uptrend, which is what was stopping the move going lower. Perhaps you could argue that you have lower expectation of the flag in terms of how far it's going to go, but I would certainly still think that that is a flag break and one that you can play with a break just there. In terms of target, your target is going to be the height of the pole. And there's two ways of doing the target, well, there's three ways of doing the target. You can add it on to either the break, the top of the most recent swing, so there, or this break here. Personally, I think you should add it on to the actual break. That's the point that the market's actually going. Whereas if you add it on to the most recent high, it's not, for me, quite the same point, because that's not where the flag is formed. The flag's formed on the actual break there. So that would be my target. And like I say, if this target is 100 ticks and you've got a level here that's 80 ticks lower, that's my target. I'm not going to go trying to get those extra 20 ticks, because of the fact that if that level's a big deal, not everyone trades the flag. And also, you've got, look at it from the other point, the other side of it. If you're not short on this flag and you go, okay, yeah, this is a flag, yeah, it's going to go down, and it's going to go down around about 100 ticks. You might be willing to get in on the break of this low down here. But once the market's gone 80 ticks, how many people are still going to be willing to sell that for those final 20 in the face of a level as well? that's for me the reason why I don't think that you should necessarily always try and play it to the target. One thing that I do watch out for is I will work the target out and watch for any reaction when you get to it, because you do often still get a reaction there as people cover these shorts, or I think there is a bit of sense that other people will work that target out as well and have a go at a very short-term scalp. So I wouldn't expect much, but I would expect just a little bounce off that target. So keep your eyes out for the targets as you get down to them. Now, the only difference between, a flag and a pennant is pennant shaping. So it creates a bit more sideways, but also neither way can actually push on. What I feel with a pennant, and the sort of more textbook version of it, is that it can go either way a bit easier, because as you break the first low, you've then got more targets to break down. So with flag, you're only really looking for the move to the downside, because there's not much of a way of playing this to the upside. Yeah, to play this to the upside, you've got to buy the break here, and as you've seen, you've got caught out every time. So it's a very difficult one to position a stop to try and play this setup flag to the upside. With a pennant, you can play it either way. You play it out that way or out this way, and then as the next highs and lows break, you're getting more and more confirmation that your trade is on. So pennant sets you up a little bit more to go both ways on the trade. Your bias generally should always still be with the direction of the original move. That's where the bias should sit. However, you know that other people are biased that way in here. People are trying to create a position early as well. So you will get just buying in here, which is why you're getting these progressive higher highs as people try and get their position on. Therefore, if you break the other way, people are going to be quicker to get out. That's where you get the sort of slightly more panicky move the other way. So there you flags, pennants. Going to have a quick look at a couple of examples. Did I go too far then? No. Right, got a couple of old school ones here, and neither of which worked. But the oil one, nice little example of a decent level getting hit. Sorry, these are both in the DAX actually. DAX one, nice example of a level that was quite a big deal getting hit and hold in the market. So you've got a drop down here from 11,583 to 522. So you got a 60 tick drop there. We break at 11,530. So 60 ticks onto there, it should take you down to 70. We get to this low, which is 88. So you get a 42 tick winner. So you're getting 2/3 of the way to target. Hit the level, we bounce back, and this is something that I am a big fan of. Not necessarily to try and play it always right the way for the continuation, but the flag retest. I think that works really nicely. I've got another example in a minute that works out very, very well. And get the flag retest. Again, this one only does half the way back and then starts to fail. So this is a little bit of a tricky retest in terms of where you're going to give up on the trade. For me, I think what you should be looking at is still this low here. That was the point that we really broke down from. If you get back below there again, that's what will keep the move going. So in all realism, you sold the retest, and you'll probably get trading stopped out just as we come back through. You're still going to take a small winner, but you're not going to get the retest and then all the way back down towards the lows. Again, we get another example in the DAX where it doesn't work. This is very nice sort of pennant. So you get the upside, downside. Yeah, we've not had too much on the upside, but this is where the art rather than science bit comes into it. There's still a pennant type pattern there, whereas this is very much your sort of original flag type pattern. Get the break, and this is where you get a very nice swing rebound candle that drops through it, closes back above, swing rebound, it's a rejection candle, and then we get the move back higher. No retest, and on the second retest you've broken the top of the pennant, and that takes you through this level, and that then starts stopping out everyone who's played for this move, who are either didn't give up on it down here, have continued selling it as it comes back up towards the top of the pennant, towards the flag retest, and then they all get pushed out of the same place, because there's no reason, if you're short anywhere down here, to still be short on a break of that high there. And that's where everyone gets rushed to the upside. And you do get a very, very quick move back up, and that takes a full 35 ticks very, very quickly. This is a 5-minute chart, I believe. All happy with that? Let's go have a look at a flag that works. Another pennant type flag, this one, on the back of a previous pennant that did not work out. So what I will include in the poll is the a gap. So in this instance, we've got the gap here. So I would view that as the poll, not just the move from here. You then get this wedge formed, and this is the difficulty here, where I don't like this as a flag, because of the fact that the top of the flag effectively is formed here, not at the top of the initial move. So the only bit of that I would call a flag would be here, that first bit down. You get the break. You get the break higher. It fails to continue. We get a retest, and then you get this wedge formed, and we'll talk about wedges in a little bit. But the fact that you get a retest and it forms a wedge and still can't continue is a reasonably bad sign. So that's the first bit of the flag, but the real flag that you're looking at is this one to the downside. And the reason that I feel this is a better flag is it's got more context behind it. We've had a gap higher, we get another gap up here, we then come off, drop through the gap, and then drop, create a wedge, or a flag, a pennant, sorry I should say, and then we get the break of it. The difficulty here is the fact that you get this false break just here. That false break, yes, will catch you out, yes, is likely to cost you, because you get in on the break, it goes, it just breaks this most recent low just here, and then fails to continue. That's a difficult one to play. But we'll look at this a little bit later on, particularly when we do price action week, and look at it in terms of trigger points in how I like to look at trades. So what I'd be looking at here, we've broken this low. So effectively, for me, that is now a bit of a trigger point that we've had an attempt at the flag, it's broken the low. If that now goes, that's where I expect the market to accelerate, because everyone who did try and buy it down here is now wrong, and it's then the second chance to have a go at flag. So we'll have a look at those when we do breakouts more in price action week. But nonetheless, on the false break of the wedge down, we test back towards the other side, can't break to the other side, you then get a second bite at the cherry, and this is where you've got to look at what the market's showing you and go with what it's showing you. Gives you a second go at it. Sell the break, you can sell through these couple of lows, trigger point there, and then we start to move. I put a Fibonacci extension on this, which basically shows you where the target is. targets down here, 13,153. You've also got this close down here, which I believe came in at 13,140. So you've got a couple of little targets down here, but if you go to the full target, you do get a bounce initially, and then we go again. Unfortunately, you can't quite see how far the bounce was from there. But that's the thing with the flags. You've got to be willing to go for it a second time if it false breaks it and then can't do anything the other way. So realistically, what should happen when you get that false break is we should go up here. If we can't do that, then that's a reasonably good sign that we can have another go at it. And you can be a little bit more confident that as these lows go now, that's where we should get the acceleration. That's where we should pick it up. But that context makes a big difference. Because we've got this gap, any reason for the market to fall, you would expect the gap to fill down there. And then you've got another gap lower, which can become your next target. So context helps a little bit here. Gap up, yes, it's bullish. The fact you then get another gap up after this sort of wedge that fails to keep going gives you all the context you need to be confident this flag is going to keep going to the downside. You then do get a secondary pennant type flag just here, very steep pennant in fact. And how well that actually retested, I'm not so sure compared with my very quick line drawing on a board. But you see the point, we once again get, whoops, I can draw in black with my fingers. You once again get a very, very similar pattern whereby you get the break and then that bottom at the same place, and it's when this low goes that you get the acceleration move. So watch out for those little play through the flag, doesn't go the first time, which then offers you a new sort of breakout point. Something I've noticed recently in the DAX seems to work quite well. Redrawing your flags and flag retests, and this is again the sort of art part of it. This flag in the Bund for me is not that great a flag in terms of you've not got a particularly big pole. That would be where I'd suggest you take the pole from. However, you could look at this in terms of the larger move and say, well, this is still the downtrend here, so in fact your pole is the peak right up here. So you could say it's from 162 down to where was that low? 160.20 area. So you could have an 80 tick target on this, or if you take it from the slightly lower one, it's 50s down to, in fact that low was 15 I think. So you can either have an 85 or 50 down to 15 and you have 35. So couple of, oh wait a second, sorry, I've got my drawing totally wrong there. It was 162 down to 160.15. So you can either have a 185 tick target or a 135 tick target, depending upon how you want to take it. Now, your first flag, if you will, was this higher one. This I think is the better flag because it takes in these three lows, so you get a more genuine trend. However, we then get the flag messed up here, and that's the tricky side of it. I think once it's done this, you've then got to stop really trying to play that flag. You've had one go here, doesn't really go. Back up, you get another go, doesn't really go. And so then effectively you've got this second flag. So I will be willing to sort of shift the trend lines down on flags to make sure that you've now got a point where you'd say that's the more genuine break. Now the flatter it gets, obviously the closer the break of the trend comes to the break of the low, which then makes it a little bit more likely that it's going to have a bit more of a solid push on it. We get the break, and what we also get the following day is this is nowhere near target, because target's obviously 135 or 180 ticks. We've broken down from 40s, we've got down as far as 65, 70 to the downside, so we've done around about 70 ticks. There's another 70 to go. Target from here on this break is 35, so your next target really should be, if you're going with a 135 ticker, it should be 159, so just there. If you're going for the 185, it should be down here. And both points, you do get a very small bounce. Sorry, you probably can't see that too clear, but on both targets you do get a little bit of a bounce. But the best thing about this one was this trend retest, which worked an absolute treat. There was a couple of reasons for this to work. You're back up to these previous lows. You tested that secondary low, so what we got here is you got a low at 34, and then you got a low here at 37, I believe. The trend came in at 36. So you had this little zone there that you wanted to sell within that zone. And that's where, as you're getting into a trade, it helps if you're willing to sort of scale it in, or you accept that you're going to sell the lower one with the knowledge that you've got the trend to help you out. You've also got that next little high, that next little low to put your stop beyond. So give you a nice little stop, you get the retest, and then we go gap down, keep going the next day. We'll have a look at this when we do profile as well, as to why this was always kind of set to go. And it's based around these lows here. And that was always set up. This move then came over ECB, which gave you a nice in towards the top, then gave you another go lower down as well for that break. But ultimately, this flag retest the next day gave you another nice opportunity on that trade, whereas you don't actually get paid if you're really trying to hold its target on that day. Turns into a bit of a flush out, and then the market drifts back up. All right, everyone happy with flag retests? Double tops, double bottoms, nice and simple. Market goes up, comes off, goes up to the same price, comes off, is the theory behind it. Now, depending upon your time frame, this could not be the same price. In fact, it's highly unlikely to be exactly the same price if you're looking at, say, a daily, hourly time frame. If you're down on a 5 minute, 1 minute, you don't want a noticeable higher point on that double top. Now, in terms of how you're going to play it, technically, there's your confirmation down here. So you don't want to be getting short until we're through this low. What that does mean is you have got a rather large stop up here, and that you've got to wait for the markets to do quite a bit of work before we actually do go. But it does mean that this level now is very important. It means that if that goes, you should see additional people come into the market. Whereas up here, it's a little bit more speculative. It's a little bit more an attempt to get in before it goes. Now, I showed you that example this morning, but this is where you can start using your candlesticks, the individual ones, to perhaps give you the opportunity to get in here with a tight stop. The other way to do it is you just go for the super aggressive double top play, and you go, right, that's a recent high. I'm going to sell it there on the recent high. Tight stop, but you're playing very much a 50-50 trade there. Yeah, it could break that level and we just get continuation of trend higher. If it works, then you've given yourself a very tight stop for potentially a rather decent sized target. Now, target wise should be the most recent low. So That's your target. And obviously, well, in this example, you can see the difference it makes to take that aggressive trade on in terms of your risk financially, your risk of it working out, this is the better trade. But your risk financially, that's a much, much lower risk trade. But you have to accept that you could very easily go up, you go sell, stopped in about 10 seconds, and that's your trade done. Equally, what becomes quite difficult as well is you sell that with a very tight stop, you go on side, you've then got to hold that. And until you break here, you've not been proved right. So theoretically, if you are going to play this with the aggressive play, you could see the market come down here, maybe make a flag, fail, back up and stop you out. Despite the fact you've sat and watched yourself 20, 30 ticks on side waiting for it to go, it can still catch you out. That's where psychologically that's quite a tough trade to take on. But from the point of view of the aggressive, cheap play, if you will, that's the way to go for it. But in any case, your stop does need to be above the double top. Exactly the same for bottoms, the other way up. What's often ideal, particularly on a daily point of view or an hourly, is where you get, this is a double top, but you get a slight swing rebound on it. So yeah, from a daily, you've got to accept that you could have, say, 0.25% above that level and then back, and that I think would still constitute a double top. Yeah, it is down to interpretation ultimately, but I'd look at that and say, yeah, that's a double top. Daily point of view, you get that break and we should be on our way. Right, couple of examples. We've got a short term and a much longer term one here. Bund, we've got a nice short term, which essentially is a bit of a rectangle almost, but this is on a 15-minute chart. Get a low down at 81, bang on double bottom. And I think that's more what you want to be looking for on these shorter term ones, you know, as close as you can get to the same price double bottom. Breaks at 02, so you've got, if you take it as a measured target, i.e. this low up to the most recent high, your measured target there is 21 ticks. Move up, we get up to these couple of little highs which come in at 22s. So there's your 21 ticks onto 02. So first target reached. If you're going for the most recent swing, we do get there. It just takes that little bit longer to do it. And that gives you a full 42 tick winner. But to go for this larger swing, you do see yourself reasonable way on side and then almost all the way back. If you're playing it from the point of view of you get long on the break of 02, you're going to see it back to within 2 ticks of you having been best part of 30 ticks on side. So that is quite difficult. So if you want it measured, that's how you'd measure it, the low to the most recent swing point, and then add that on the break. The fact that that coincided with these couple of little highs before the breakdown makes it quite a nice little target area. Now, much, much longer term. This is a BTP weekly chart. Incidentally, this was bang on a double bottom to the tick on a weekly. So you break again, and this is where you have got to think about it more in terms of context rather than taking this trade on position wise, because you're going to give yourself a full 350 tick stop if you buy it here and go, right, my stop's down here. Works out all right though, so yeah, you don't have to worry so much. But yeah, it's a very hefty stop. You know, one lot, that's still 3.5 grand if it goes wrong. But your target on this, as I say, you've got 350 ticks to the upside. So that's going to take you at least to here, which is the most recent swing high, which is nearly 350 anyway. So 300 would take you to 134.88, and the 50 would take you to 135.38. That's just below there, just above 135. I think that's 135.25. So you do get there eventually, but you've got to wait 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks to do it, which is a rather long time to sit in a trade. Nonetheless, you don't really ever get put too much offside. You get a couple of pushes down here, and I guess you could argue that actually that should be enough to stop you out. You've got a close and an open below the breakout point. So context-wise, I think that one helps. If not, yeah, you're looking quite tough to actually manage to hold on to that trade. All right, this is the S&P one. This is the last time we got a really sort of big double bottom. This was January, February 2016. Solid double bottom. I think this was within a handle of each other, and you can see how far we've moved, because that was 1776, which I'm sure the Americans are quite happy about, because wasn't that the date of independence, 1776? So that's probably why they bought it. Incidentally, the Dow at the low in 2009 was 666. Someone bought that, I'm sure, thinking this might be the low, I've got lucky, and gave themselves a 5-tick stop. I hope if they did, they are still long. They would be very happy. No, sorry, it wasn't the Dow, it was the S&P. As I said that, like, the Dow at 666 is now trading 25,000, or was not long ago. Yeah, the S&P 666. Anyway, so going from there to there, you've got 130 ticks if you're doing the measured target. We then have the most recent swing, which comes in at 2080. So 130 ticks onto 1906 is going to give you 2030. So that's just around about these little highs here for your pullback, and you then do break that most recent high as well. So works out rather nicely, this one. And again, unfortunately, from a daily point of view, you would likely have got stopped out on that little dip back lower. So again, use the context of it. Once, yes, you've had that dip lower, you get the push up. Once you've got this day in, then you can then start looking at it in terms of, I want to continue looking for longs on this move. And we do get it, we get that move a fair bit higher, but both times, you know, very difficult to stay in really on trades like this, because of the fact that it's a much bigger time scale, and so the market is not often going to go so precisely through these areas. So if you are buying this breakout, you do perhaps need to give yourself a bit more space. However, you should also be watching closes of candles, and the fact you get a close that's back through does negate that trade a little bit. So that's the S&P. Nice little double bottom example. Everyone, whoops, coat fell off the wall. Everyone happy with those? I think they perhaps a little bit more tradable and a bit easier to play when you take them onto a shorter term. You know, looking for effectively a break of a small range rather than a much bigger term situation. This is the S&P at the moment. We do have a very nice possibility of a double bottom playing out. It's a double bottom on a pullback as opposed to a double bottom at the end of a move necessarily, but I guess you never know it's the end of the move until it is. So 27 is the area. That gives you a 2-point move to the upside, which will take out the previous record high if we do manage it. So that, I think, is going to be your key area. These little lows here come in at 35. So whilst 27's key, you could see the possibility of 27, 35s and then drops back below. If it does that, then that's sort of saying to you, maybe this isn't going to work out so well, or it's at least going to require another move, another close, and some kind of close above 35 before you can then start having a go at it properly. So it's all about how we actually get there, what we do when we get there. For me at the minute, we're back above this key low, 45 and a quarter. We are currently trading 48 and a quarter. So we've had a go above and we're not really moving away from it too much. So if we can start taking out the current high of the day in the S&P, that I think will sort of semi-confirm that we have broken this level and we're going to go higher. If we don't, if we once again drop back below those 45s, then that's your next target, 17s, 18s area. And from my point of view, hopefully we crash through there and we have another go lower. But volumes, activity does seem a little bit more muted today, certainly than it has been recently. So I think perhaps not a day to get overly excited. It is also a Monday as well, which is often quite quiet. So yeah, that's your double tops, double bottoms. We'll be watching out for that in the next few days. Other ways to play it, with the fact that you've got this as a double bottom, effectively, you can start looking at other areas to get in at. And so as we came back above 73 and 77, that could be your opportunity to get long and look for the move at least back through this little range here. Your other area, of course, is on the break of this little flag / range. You know, we've broken lower, we've failed to extend it any lower through here. So once you get back inside this range, you then look for the break higher through it. So it's not all necessarily about being long at the 45s. You could have been long on the break here and try and hold on to that to give yourself that opportunity of getting through 45. Now we're through, you can start thinking about where you could shift your stop up to try and stay in this trade and try and run it for a little bit more of a longer term. All right, head and shoulders, probably the most well-known pattern that everyone's heard of. I like a head and shoulders because I think of all of them, this does actually have quite a lot of logic to it. In that head and shoulders pattern, you go up, down, down. Quite nice, clear reasoning for me behind this. You've got a trend in that you've got higher highs, higher lows. Then you fail to get a new higher high. And the point that we get through this low, just here, that shows that the trend is over. That everyone who's been buying this and trying to hold on is now wrong. So that's why I like a head and shoulders pattern. That's where that positioning is going to help you, in that the positioning long here is going to have to start trying to get out. Now, in terms of playing these patterns, you're looking for the neckline. Neckline is slightly difficult sometimes in how you draw it, because what you can end up with is a neckline that's too steep either way. Your alternative, you can have an upward sloping neckline, or you get a downward sloping neckline. Now, I've heard different theories on why people like either one. I prefer an upward sloping neckline because it allows you to get in before this break. The argument with the downward sloping neckline is we've already taken out this low, and so the fact we've done that, this is merely just a place to tell you that you're definitely right on the trade. Probably a downward sloping neckline, your entry point gets further and further and further away as the move already is getting going. In terms of targets, I'm looking for this distance here, neckline to the head. add that on to the break, and that's where your target's going to be on that head and shoulders pattern. And this is what makes this one difficult, that you've already broken this level, we're already going, and then you're going to add on that move as well. So I think you can end up having a target that's perhaps a little bit too far. But both head and shoulders patterns, both should in theory work out the same way, but I do feel that those sloping ones that are sloping with the direction of pattern can often be more difficult to get on, and you're already allowing the market to go a long way before it's done the move. Ultimately, you want to be in on the break there, and then that way, at least if you get the break of the neckline as well, you could then start to shift your stop. And the nice thing about the downward sloping one is your trailing stop gets you further and further in profit all the way down. Whereas like a flag with the upward sloping, your stop is back above here. So your stop gets bigger and bigger and bigger as the trade goes on. In terms of retests, I think a retest's good if you've bounced from this low or you've not quite reached it and then retested. If you've broken the low, so effectively false broke that low, I'm a little bit less inclined on that retest, because the false break of this low is showing you that that trend has failed to turn around, and now you're going to get people thinking, right, that's the next move, because you've false broken the most recent low, if they're not actually looking at it in terms of a head and shoulders pattern, looking more in terms of the bigger picture pattern. Right, so we'll go on, have a look at a nice example in the euro. This is a big one on hourly, but what you also got is you got a head and shoulders within a head and shoulders. So you got a shoulder, same head, and a shoulder. So that was quite nice, gave you the opportunity to get in on the break. What it also did very nicely was gave you a little retest here. So we did just break this low, so yeah, you could argue it's a false break. Only slightly, you effectively got a double bottom there. Comes back up, retest, and then we go again. Get a break of this neckline, no close back above it. We then hold below. Yeah, we got two tests there, back up. Neither of them closed beyond it, so that's all a good sign. Target-wise, well, you're looking at 1700 basically, up to a high of 2150. So you've got a full 450 tick target on this, which is going to take you right the way down to 1250. However, as you can see there, sorry, I've boxed it, I don't need to draw around it. 200-day moving average, that for me was the target on this. I know that this trade Brannigan took on and tried to run it all the way to the target. Unfortunately, that's what happened. You got the move back through the break. So these are those two retests that we showed you just then. Get a break lower, you get a swing rebound candle, and then you get the close back through the trend. As soon as you're back through that head and shoulders, then you're stuck, basically. You've been proved wrong, and then the market does continue to move higher. Now, if you played the earlier head and shoulders, so this one here, and got yourself in on that retest, preempting the bigger pattern, you at least gave yourself a chance that once, yeah, you've been proved wrong and you got a close above here, you're still taking a 100 tick winner out of it. Unfortunately, if you got in on this one, or got in this area down here looking for that continuation lower, unless you just got out above this high, you're taking a pretty hefty stop if you're going to wait all the way to the close of that candle. So unfortunately that one didn't work out, and we then got the reversal the other way, new highs on the year. Right, much shorter time frame, and this is kind of what I was getting at in terms of time frames and ranges. Now this is where we got very volatile. This is an area where you do need a little bit of interpretation in how you draw this, because technically I would suggest that that's your shoulder, that's your head, and that's your shoulder. So the neckline is drawn from the low of each shoulder, so your neckline should go like that. For me, add a bit of interpretation in, and I called that your shoulder. This is effectively your head as all one move, back down, next shoulder, and then the drop. I know that some people talk about the distance between shoulders should be symmetrical. I don't think that's entirely important. I think that it's more about the pattern itself rather than the symmetry. If the pattern's still there, does it matter that it's taken slightly longer on one side? But this is my point on the sort of time frame or range of the trade. So this is a 1 minute chart, but it's giving you a 100 tick target. Plays out quite nice. This was the one that you took on the other day, Ollie, and smashed it. And yeah, it took, 10 minutes to do 110 ticks to the downside. Now, a 1 minute chart on a reasonably slow day, i.e. today, I wouldn't necessarily be trying to play the head and shoulders pattern, because it's got a lower likelihood of playing out. If you've got a reasonably small range on the day, and you've got a 100 tick target on a 1 minute head and shoulders, that's likely to cause a range extension on the day. If you've got quite a narrow day already, you're not likely to get a major range extension. You know, you take the DAX for today, for example, and we've done, what's that? Yeah. Have we done 200 ticks today? I don't think we have quite. So much, much lower range on the day. Yeah, this on Friday, very nice 110 ticks. So if the ranges are there to be done, and if the sort of speed is there in the market, then it's on. Again, another one, inverse head and shoulders this way, that's basically your neckline. But what you've got helping you is this downward sloping trend here. So you can view this as a head and shoulders and then use this trend as your way to get in on it, rather than having to wait for this neckline to go, and then you're going to be getting in up here. Still works, both the same. So this is where that argument that the slope in the direction of the break comes in handy, that if you've bought it there on the break of these highs, the break of this trend, by the time you reach the actual neckline, you're already on side and you're just waiting for confirmation. Breaks and you get the move higher, and I would suggest that went quite a bit more than target and just continue to grind on higher. So you'd end up getting out of your target perhaps at the high of this little drop down, just there, and then we do push on higher. But ultimately, there's no point in worrying yourself about something that happens after it's reached your target. That's not what a target's for. Target's to make sure that you actually make some money out of the trade. So if it keeps going, so what? You have to accept that and move on.
It is just a multiple hit.
Sorry? It's just with multiple. Yeah, ultimately, yeah, it is basically multiple head chart. So, yeah, that's the way I look at it. That you've got two distinct lows here. So that almost is the lows of your head and shoulders. And then the bit in the middle, that's your head. So yeah, multiple head and shoulders, if you will. You will sometimes get one that's got this sort of quite distinct shoulder, head, and then the left shoulder will go like this, and then, sorry, the right shoulder, and then break lower. So for me, the width and symmetry of shoulders, I don't feel matters drastically. Obviously, if you get a very sharp one that then just goes like this for a long time, this does then start to become a little bit of a negated pattern. And I would feel that as this type breaks, you're going to get less people actually acting on it. And so that's the only reason that it's perhaps not going to work as well if you get that much longer one shoulder. Incidentally, head and shoulders pattern is one of the only long-term trades I've ever really taken on. Is an inverse head and shoulders in natural gas, which worked out all right. Right, wedges and triangles, basically the same as pennants, apart from the fact that they don't have a pole or something to sort of guide the target on them. So first up, I try and draw this quite nicely. What I should have drawn was drawn the wedge first, is where you get a downward sloping wedge, and that's a terrible attempt at drawing it. So what we'll do, downward sloping wedge, like that. Now, what a downward sloping wedge is showing you is, yes, we do still have direction, or this could be an upward sloping wedge the other way, but the commitment to that direction is diminishing in that you're getting less range extension, you're not getting any sort of playable pullback like that, whereby you can clearly say, right, I can sell the pullback to this previous low, or you can sell the break of lows. There's not a great deal like that. So what the downward sloping wedge is showing you is that conviction's running out on this trade, but we are still going down. So you've then got to start questioning yourself, what can happen that's going to really get the market to accelerate lower in an already slow downtrend? So these type of wedges are more likely to break to the upside, and as they do, you've got multiple points to target on the way up, and theoretically beyond each point there's going to be stops. So you should get a move that then accelerates as it moves through those areas to the upside. So quite a useful type trade. If it does continue to the downside, then it does make it quite difficult to really sort of, certainly to try and play it for a break lower, you're going to have to sort of try and get on some kind of pullback. But as you can see, selling pullbacks is not working because each time we get the pullback, we're pushing through it. So that's your downward sloping wedge, upward sloping wedge, the same. You will hear people often call it a smoking chimney. It's an upward sloping wedge, looks like a chimney that's on fire.
Good chimney.
Thanks, top chimney. Yeah, that's the phrase that has been coined for it. It's a smoking chimney. Difficult ones to actually trade in terms of if you're not already in, if you're in short here, it's not too bad a trade because you put your stop there, or you put your stop there, 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 and then you'll probably get stopped out in one whoosh, and it will stop you out. But ultimately, you've moved that stop down, so you don't care. So that's your upwards or downward sloping wedge. To make anything out of this, you do need to be in on this bit of the move, and then accept that with a lot of moves, you're going to get consolidation before the next leg. So this could be your consolidation bit rather than the consolidation that pulls back in terms of flag. You just get consolidation like this. Next type of wedge triangle is where you get the flat topped wedge. Again, what this is doing is it's showing continual resistance at the same point. So what you're getting is a progressively weaker level. You're also getting sellers that progressively can't move the market any lower. So this creates positioning again both ways, and we'll talk about this when we do profile and we do ledges. It's a similar kind of principle, that what's happening is each of these pullbacks, people are buying it and buying it and buying it and buying it, thinking, right, it's definitely going to break this level. The problem is, if it doesn't, you've then built up quite a lot of positioning here that is then all going to snap together to the downside. So those type of wedges, I do think the better move is the move to the downside, and I'll show you a nice example in the NASDAQ in a little bit, which is part of a later slide to illustrate a different point, but it starts off with a wedge very much like this that can't break the highs. Also, another ideal situation is you get a false break here to the upside, and then you get the move to the downside. Now, this is something I didn't mention when I spoke about pennants. If, and this is the technical side of it, if you've got a pennant, a triangle, a wedge, once the market has gone more than 2/3 of the way through, it's deemed invalid. This is the same as a flag. If it's gone more than 50% back, it's deemed invalid. That is an interpretation thing for you. If you still feel that the market is following one of these trend lines, then to me, it's still a valid trend line break. So that is still important. But 2/3 is where it's deemed not to be in play anymore, and you'd expect the market then to continue to range off. But like I say, if it then does continue through 2/3 and drifts and holds that trend, I'm going to expect that to remain in play and to continue that way. But they're your main two types of wedge triangle situations, whereby you get a downward sloping wedge after a downtrend, upward slope or flat topped wedge, which creates positioning quite strong positioning in both directions. So the break of those flat topped wedges or triangles will often create quite a decent type move. And we've got a nice little example. This is a Euro one, and for those of you a little bit keener on the eyes will notice this was one I used the other day when we were talking about monetary policy. What you get is you get this downward sloping wedge that effectively showing weak positioning going into an ECB interest rate decision, whereby people are trying to sell it. This was the initial part of the move. That was the aggressive bit. You then get a wedge here, which does break to the downside. You then get this continued downward sloping wedge. Not enough to get the market to go lower. And then you get the aggressive push higher, which takes out all the positioning all in one. And that is always a bit of a risk, that if there is some news that helps this type of move up, it will take all of that positioning quite quickly as people rush for the exits. Because even if you've got your stop here, if news goes the other way against it, people are going to try and get out down here. So yes, you'll get rushed out, but you're probably still going to be better off by trying to get out faster rather than taking your stop way up here. So that's the resolution of a downward sloping wedge. What we've got here in DAX, nice little sideways wedge. Effectively, this is a pennant, and what you're getting is no push lower. Holds the level, holds the wedge rather nicely. You get a little tick down just here, and then the push through to the upside. One thing I do kind of feel with these pennants is the longer it sits in it, the more likely it is to break the other way. I think that's perhaps because the position in short is in the expectation of something. The positioning long is perhaps a little bit more positioned because people feel that these prices are offering value, whereas the short positioning is based on this most recent fall. And so the longer it goes, the less, well, the shorts are not getting paid, and then they're more likely to start worrying about positions and then start getting out of them. And that's what pushes it to the upside. And nice recent one for the S&P. Got this wedge created, and this was a few weeks ago, this 24th of January. And what we actually saw here was suddenly, or not suddenly, but we started seeing larger ranges coming into play. The S&P prior to this, you were lucky to see a 10-handle range in the cash session. We then expanded this in these couple of days. We expanded it out towards 55s down towards 27. So still only 25, 30 handle ranges, but the ranges suddenly expanded. We create a wedge up here. So, you know, you've got that range extension lower, can't break lower, push back into the range, extend lower, can't take the previous low. Then it's going to be a case of which way it breaks. The overall trend at the time, definitely to the upside. So you can have a slight bias, a little bit more to the upside. We get it, we hold the top of the wedge there. So that's a nice little proof that this is a valid trend line. You then get the breakout, and very nicely, the break obviously gives you the in before the break of what at the time was the record high. You then get the continuation, and you get, because ranges have started expanding, you get a 20 handle push to the upside. 23 handles, in fact, if you go 23 handles on top of that little high. Coming off, and you then get this, it's not quite a wedge, that's more a channel. And then we do get the break of the channel to the downside, pull back in to these previous lows, and that was right on non-farm payrolls. The first Monday of the month, first Friday of the month, first Friday of the month, pull back on payrolls, and this is where it all kicks off from. Basically, the moment that payrolls, which was a beat, there was no real reason for the S&P to come off, excuse me, could not get back above 28.13. That was the beginning of it all. And then we did 40 handles to the downside. We then later on that evening did another 100 nearly to the downside. So that's the most recent wedge that we've seen really break out in these markets. And the reason why this is a wedge more than the flag was because prior to this we had been sitting in reasonably muted ranges, just sideways, sitting at the tops. So definitely more a wedge than a flag. The other thing with a wedge, a lot like a range, is when you get the re-entry, you expect the move through the other side of the wedge, which is what we got. Yes, it's only a smallish trade, it's only about 10 handles there. But you do get that move to the other side of the wedge as everyone who's played out then plays it back through, gets out of their trade. So, nice little example of a wedge. To the upside, gave you a chance to go for the breakout with the prevailing trend, and then it fails, drop it through the wedge the other way. And this actually is downward sloping wedge channel that does actually break to the downside and continues. All right, 3 types of gap. Got breakaway gap. Breakaway gaps are important, gaps that you should go with. As a general rule, go with a gap. If there is a gap, the assumption should be that you will go with the gap until that gap fills in. Now, I'll talk about examples where that doesn't work, and that's when you get a move that is generated by another market, i.e. you look at the European equity gaps in the last week when they've been caused by a continuation of move in the S&P. So European equities gap lower. Effectively, all that's happening there is they were hitting stops out to the downside on that gap lower and then get bought back up because there was nothing fundamentally in Europe that meant we should be off quite so far. We'll talk about news-based gaps a little bit later on when we do event week, and how you do sort of get these type of gaps and what type of reaction they cause. But your three main types of gap, you get a breakaway gap. This is the kind of thing that starts to move off. This is the kind of gap that you want to be going with. Yeah, it is often a little bit news-based. You get that gap and the market goes with it, takes on that bit of news and runs. So that can kick off a move, brings you out of a current range, brings you out of a current area. Next up, you get an exhaustion gap, and this follows a breakaway gap. It might not be the next day, but it might be a few days down the line. The exhaustion gap is showing you that basically people have panicked and rushed so much to get in that they've caused a gap up or gap down. This can then end up being the high or low of a move. It might take a couple of days of sitting up there, and this is exactly what we saw in the DAX a couple of times recently, whereby you've had this gap up, and it fails to continue with the gap and then comes off.
It's kind of an island reversal.
Yeah, that's the best example if you can get an island reversal, whereby you have a move lower, a gap down, and then the market gaps back the other way. Totally leaves that behind. That's the textbook, probably best reversal you could get. You sometimes hear it referred to as an abandoned baby, which is nice. But yeah, the idea of an island reversal is you gap the market one way, so get sentiment very strong one way, and then gaps it back the other. Should theoretically create a nice high or low. One thing with news-related gaps, if the market doesn't trend quite early on a news-related gap, or if it does a large, very large initial move and then stops, you're likely to get a reasonably quiet day after that, because the fact that the gap has either taken positions out or got people into new positions. Once that's done early on, you're less likely to then get people entering more positions, because the opportunity's gone, because the gap's taken a lot of that opportunity out. The market's then moved a fair bit higher. You've got to question why anyone really wants to get in there. Likewise, if you were positioned and the gap's gone in your favour, you're not going to rush for the exit if the market's not coming off. So news-related gaps can often sort of create slightly quieter type days. And here we go, nice example of a news-related gap. And what happened on this day was essentially a jump and a rush, and that was about it. And so whilst this looks a very strong day in the Euro Stoxx, we got basically a jump up, flick down, charge higher. This was on the French election. So you got a decent gap up. That's your breakaway gap. You then get your exhaustion gap just here. Not a particularly brilliant exhaustion gap because it's quite small. Market then does continue higher, and this is the thing with an exhaustion gap. Whilst it's showing exhaustion, it doesn't necessarily mean the market's going to turn straight away. So you can keep it in mind that this is likely to get filled at some point. Doesn't mean that the market's just going to gap up, sit there, and then come straight back to it. So it becomes something to play for. With almost all gaps, at some point, a market will generally come back and fill them. It's rare that you will leave a gap. It could be quite some time before it does it. And I think that's part of why this move in the S&P was needed, because there were quite a lot of gaps lower down, particularly on the cash session, that needed filling in. Market came off pretty much, as far as I know, filled all of them in. So it's done what it needed to do in terms of filling gaps. So yeah, do watch out for them always getting filled in. You then do get this gap gets filled right the way down towards 34.40s. This much lower gap has been filled recently in Euro Stoxx, in fact. down towards 3370, 3380. That was filled quite recently, I believe. So they do all get filled. This nice example in the DAX as well. This is where you get actually, this is an ideal breakaway gap because you're getting a break out of a range. So you get the jump out of the range, trade higher, continue, exhaustion gap higher. So you're then looking for this one to come back, at least as a minimum to fill this gap in. Really, you could be looking a fair bit further than that. Did I put it up? No, I didn't. That exhaustion gap was, that gap there was the precursor to that wedge in the DAX that then created the flag and fell. So that's what came just before it in terms of the daily setup, that you got the breakaway exhaustion gap. And so again, when I was saying with context that you got that gap to fill in, it was this context of the setup of the gaps that made that a little bit more likely to fill in. You know, the breakaway gap, not necessarily quite so clear cut. And again, this breakaway gap, which came from September last year, was at 12,272. I know that because I noted it down the other day as the DAX was falling off, and we have obviously filled that as we got down towards 11,900 in the DAX. We actually dropped 300 ticks through it. But these are the areas, these are the things that do get filled back in at some point. So whilst we left it for, what's that, the best part of 6 months, we did actually get back there and filled it in eventually. So watch out for that type of setup. This one, yeah, came off, filled the gap in, dropped. We then got another gap up. So sort of double exhaustion gap in a way. But I negated this exhaustion, then exhaustion again, and then we came off. All right, island reversals. These are rare. You don't come across them very often. In the US, if you're looking for an island reversal, really you've got to be looking on a cash chart, because the fact that it trades 24 hours with the 1 hour break in the middle, you've got to get a large bit of news in a very small break to create that island reversal. Whereas with the cash, you don't so much. Now, neither of these island reversals in the S&P, and just a clue as to how long ago they were, S&P trading at 1135, so this was a long time back. I think probably 2009, maybe 2010. What you're looking for, and this one, the textbook is it's done on 1 day, but the principle holds whichever. You get a gap lower, you then get a gap back up, and this should be entirely on its own. Unfortunately, it's not quite textbook in the sense that this first gap down actually filled the lowest point, but you do then get a gap up above that high. How to play these? Ultimately, you've got to buy it on the gap up with your stop for the gap fill. If it doesn't do it, you can still buy it on the gap fill as well. So it's an island reversal that fills and then goes. So you buy it on the gap fill. Target wise, you are looking for a new swing high. So in both instances, you got above this high, and we just about managed to get above that high. And then you do also see nicely in S&P just here, a little gap. So you got the island reversal, gap up, breakaway gap, exhaustion gap. Well, you could argue that's the exhaustion gap, and then you get another gap on top of that. So that's something the S&P likes to do, gap, 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 and then you end up with these ferocious drops that then come and fill them all back in. So watch out for those. They are rare. It's the kind of thing that if they do come up, you're probably going to get a lot of people talking about it, so you probably aren't going to miss an island reversal. And that should then change your bias, at least for the foreseeable future. In terms of actually taking the trade on, it's quite a tough one, because of the fact you've got to have a stop all the way through that gap. But if you do want to have a go at a longer term trade, that may well be one of the better options to have a go at. Right. Don't see many of them in Europe. Excuse me. Last couple of little ideas. Rectangles and range breaks. This is something that Nick calls a an auction block type trade. So whereby you've got perhaps a move higher and then you sit in a range and then drop out the range. And so that's your kind of auction block idea, that you'll move from one block of auctioning or one block of range down to the next block. Something that does seem to happen in the Bund a reasonable amount, that you get these little blocks.
Much shorter time frame, isn't it?
Yeah, sort of on a 5-minute chart. So two sort of ways of looking at that. That's your sort of auction block on a shorter time frame. You then have a range, your ranges on the larger time frames. Now, what you're looking at in terms of ascertaining when they're going to break, when they're not, for me, the best indication of a range break is the drop out and move back in. That, I think, is the ideal situation, because it's showing you that there's a failure to go the one way. You can then start playing the move from just inside the range, and your target at least the high, and really should be the breakout. So you've got two ways of playing it. You either get in down here, or you play the breakout trade up at the top of the range. Very similar to that FTSE 1 minute one that I showed you earlier, that it was a very extreme drop out the range, so the drop was more like this, but the idea was still there, that as you came back through the range, you could play the breakout up there. So that, I think, is generally the best way of playing these. The difficulty with any kind of range trade, and it's always something that you'll hear people say, oh yeah, well you just play the range, just buy the low, sell the high, nice and easy. The difficulty is, by the time you've worked out that this is a range, you're getting to the point where it's more likely to break. The only time for me that I feel that you're ever going to be able to range trade something is if, say, on this move higher, you've got a level there, comes off, you take your profit towards the low of the pullback, goes back up, back to your level, and you think, okay, I'm going to have another go at it here, and now my target's going to be down there. At least that way, you've taken on the first couple, you can afford to then keep going at it until you get the break. Whereas the majority of the time with a range, you end up with a situation that you get the pullback, fair enough. This could end up being a breakout, it's not. You get the pullback, you might buy that one. You could then play the range like that. You would have still...
An argument that is double top, right? So
well, yeah, exactly. So you could argue it's a double top, so you might try and play the break here. So that won't work. Are you going to sell a triple top? Probably not. So you don't sell there. Yeah, you could buy that one now because you've seen that there's a bit of a range established. But the longer the range is established for, the more and more likely it is to break out. So this is why it feels quite difficult about range trading, that after the fact it looks like the easiest thing to do. You could have sat there and just taken your 10 ticks over and over and over and over and over, and you then wouldn't have had to worry yourself with the breakout. But you would have to worry yourself with the breakout because you would have bought it there, so you still get stopped out. The thing is, if you have played it as a range, you know you're going to get stopped out at some point. You have to accept that and take that loss on there, because if you try and preempt it, and you preempt it breaking here, and even if you don't buy it, even if you don't sell it, you'll then stop taking away your profit on the range. So when it does break, if it then gets you, you're reducing the amount of profit you make before you get the stop. So That's the difficulty of a range. I think the best setups for a range are one, the dip and back through, or you get the break, retest and go again. That's the other way of doing it, or the other nice setup for these range type breaks. When you get the retest and go again, you've either got the opportunity to sell the retest or sell the break. So you get two opportunities on that. You get two opportunities here. That's an ideal situation, that you buy that drop back to the bottom of the range to play it for the breakout here, and then you can either pyramid it or buy the break. So that's how I'd look to play those type range situations. It's nice to think that you'll be able to play the range, but I do think that is actually one of the harder things to do. This is where your candlesticks come in so useful. Those rejection candles, fantastic for calling these range breaks. Likewise, if you get a candle that takes out the whole range in one and then gives you a nice inside day towards the top, that again is a nice little setup to get you out the range. So use those candlesticks on those situations, on those range type breaks. All right, so let's go and have a look at a couple of examples. The other thing with ranges as well, this is a Euro Stocks one, recognizing that a range will have almost a range of an edge. So the range will have an edge which is a range as well, in the sense that, so I'll just put these numbers on for you. So that's 78 and 73 and 09 and 18. And you can see the Euro Stocks, yes, it essentially sits in this main middle band, but you've seen it drop down here, spikes through and holds it there. That's the one. That's your false break. Comes back, holds it. That offers you a nice tight risk reward. You buy the 73s, stop below there. You're expecting the move back through the range. Whereas to the upside, yes, there's your range. 09s is pretty much the high of it. You get a break up to 18s, 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 holds it every single time. And so that's where you're not so much actually breaking the range, you're just moving to the range at the top of the range. So you do have to sort of realise that situation, that it's not always the first time. Then I do agree with this 18s here. You break out, drop back in, and that's the one that goes. But once you then get a secondary breakout that goes to the same high, that's the one that when it drops back below 09s doesn't actually go for the other side of the range. Just by virtue of this has effectively created a new top of range. And then you get the ideal situation where you get the actual breakout, doesn't continue. You can buy at either 73s, you could buy the move back above 78s, or alternatively, you've then got this top of range area to get long, because of the fact that we have had three touches up here. You could almost argue 4. So that's where you've been given the context on the false break. You then get the setup to actually go for the breakout as well. So that's an ideal sort of rectangle break. And that was quite a long term one. This lasted basically the entirety of October, that we sat in the Euro Stocks in a 45 tick range. And that was the extremes of the range, was 45 ticks. The majority of the range was spent in 30 ticks for a whole month. So compared to what's currently going on, that is pretty disappointing, I'd suggest, for the Euro Stocks. Right, so let's move on, have a quick look. Little example of Bund. This is more Nick's kind of thing. This one over here is a daily breakout. This was the post-Brexit period in the Bund. So effectively, you got a range that lasted around about 6 months, all within the entirety of the range of the 1 day of Brexit on the Bund. And it was only once you got this false break up at the top here that you then got 2 days down and a move down towards the lows of this range. This low incidentally filled a gap that was just prior to Brexit, so the gap down here, should have put that bit on the chart really. Yeah, that low filled the gap in and then we moved back into range. But until we got this false break out, which wasn't even a false break because we closed above, but as soon as we started trading back in, that was the only bit where you got some clear direction in the Bund for around about 6 months. Shorter time frame setup, and here's your little range in the Bund. Nice little double bottom type setup there. Breaks it and you get that move higher. Again, you get another one of these little auction blocks, and that I think is quite a nice one. Because the fact we've come off, come back up, auction, test out, we can't reach this high either. So the fact that you can't actually reach a high on a push out, again, is showing that that attempt higher is actually a reasonably weak attempt. Market drops back in, selling comes in, and that then takes us lower and takes us pushing right the way down towards those most recent lows. S&P's only just open, right? It's only half two. Yeah. So I was just looking at my chart, and so we had quite a strong drop and then reversal. Yeah, and that was in the pre-market bit, sort of like half an hour pre-market. So hopefully it does mean that that volatility is back, it is here to stay, and Europe just hadn't quite picked up on it, so could have quite an exciting afternoon. But yeah, nonetheless, you get this range break. The one thing I didn't suggest about ranges is again that measured target idea of things, that you should be looking when you get these range breaks to go for the width of the range as your target. So in this case it was 60s down to 42s, so you've got 18 ticks. That takes you quite nicely on the break of 42s, gives you your first target down at 30s. Your 18 ticks keeps you in the trade, keeps that move going. And so once you've got below these 30s, you can then put a trailing stop and try and hold on to it for a little bit more. And you then actually get a target down here, top of that previous little range block. So all for me, I think that the key thing is that false break of range. Alternatively, you're going to have to be looking at it in terms of when we do price action week, this will show up a little bit better. What happens just here that gets you into a trade? That little bit of something in the ladder that gets you in that trade. There was a really nice example last week when we did that Bund. It sat in a little block of about 15 ticks at the low. As it pushed out of that, you saw it sort of pick up the energy a little bit, and then it started to go. That's the kind of thing that you're looking for if you don't get the candlesticks show you already. If the candlesticks don't show you, you can have a go, based on price action. Of course, this was probably a similar thing. Showed you the move higher, showed a bit of pace in the move, couldn't sustain it. Yes, you're likely to get stopped out as it comes back, but that's given you the information that you need to say that this is going to go lower now, because those buying attempts have just failed. All right, last couple. This is something that perhaps you don't always see, or just like move away from the standard thing. And it is a bit of a range break type situation again. It's something that I think works quite well in the Bund, but I think works equally well in most other markets. It's just that the Bund's where I noticed it first. What I call a symmetrical drop. The idea of a symmetrical drop is that you get an explosive move up a range, and this is the point with it, that after you've seen this sort of strong move that's basically showing you people want to buy this market, you don't get a wedge, you don't get a flag, you just get range. And that's showing complete two-way activity in the market. There's no real bias within the market. And as you've got that strength up, that lack of bias really is kind of saying to you that there's uncertainty. So effectively, that's creating a slightly longer time frame doji, just sitting at the highs. So what you're looking for there is the break here. As you get the break out of the bottom of the range, you can expect a reasonably similar style drop in terms of pace and in terms of distance. So I'd be looking for back towards the lows of that previous move when you get these types of drops. That's what I mean by a symmetrical drop, that it's not just the pattern wise, it's also the way it does it. Yes, this isn't quite exactly the same. Yes, this had a much more clean sort of 20-minute move up compared to this, which did stall initially here. But once it really started going, that acceleration down was very akin to this acceleration up. So you get the symmetry in it that way.
I think right now on monthly chart, Bund looks like this.
A monthly chart?
Yeah, without the drop.
Oh, really?
Yeah, it's like, I mean, not exactly, because it's more kind of this. The pole is not just one
Yeah.
bar, but it's kind of similar.
Let's see if I can get a monthly Bund up.
From
On a
June
week.
2015, something like around.
That's kind of what I've got.
I mean, there is range at the top.
Yeah, but I do see what you mean. That yeah, you've got this quite quick push up
Yeah.
here. That's throughout 2016, and then you get range. So yeah, if we do get this drop here, yeah, you could argue you're going to get a symmetrical move down towards these lows, this big peak of volume. So 148's in the Bund. Sell it now. 10-point winner. But yeah, I do think the Bund. This is the problem with charts, that different charts will look different because of futures continuation settings. But for me, yeah, down at these lows down here, I believe these lows are 57.11 and 56.91 or 92. That for me is pretty key. I think if we break through there, that could be the setup for basically the symmetrical drop. And you could see a sustained couple of week drop in the Bund that could be very, very harsh, very big ranges, very fast move. So hopefully you're right. Hopefully that plays out, which would be lovely in terms of activity, in terms of range. Then if you want to move and start trading Bund, which will be fun. Right, moving onwards. So that's your symmetrical drop. We've got a nice example of it in gold as well. This is a symmetrical drop with an upward sloping wedge, which is not too great to draw. I think you're probably better drawing it like that. Yeah, upward sloping wedge, but the move starts with this aggressive move higher. As that wedge breaks, and also you get a nice little bunch of lows to go there as well. The lows go, and you get the very fast move straight the way back down to that previous low. So another nice textbook symmetrical drop. Of course, you could have it the other way. It could be a symmetrical rally. It doesn't always have to be a drop, which is what we saw in the Bund the other day, out from that 39 area. What S&P does look like the rally is on. All right, one final setup that I do quite like is you don't see it all that often because it requires a little bit of time, but certainly for a sort of quick scalp type trade that can put you quite nicely on side. Whether you're going to play it for a much, much bigger move is up to you, but I think certainly as a quick scalp trade works quite nicely. And what happens is you've got a clear low, you get a fast drop below this low, and then you get a slower move back up to it. And it's the fact that you get that slow curved move back up. It's not a sort of drop and straight back to retest. It's that slow curved move with that final sort of fast push up. So effectively what you're getting is people selling it, that then slowly the market comes up and up and up, catches those shorts out, they rush out up towards previous support, hits, quick pullback, and then the move does continue on lower. So you've seen that, it's a nice example in the euro. You get exactly the same picture in the euro. Sorry, that's in the pound actually. This one's in the euro. After you had a very strong move higher, you then get double inside day, which causes the rush up, straight up to previous lows. And this, again, you can see that roundedness of it all the way back up. So watch out for those. It's all about that quick final move up to previous support after this curved move, whereby people are getting short, and then they get trapped as the market rushes back up. So I keep looking at the S&P in case there's something kind of going on. A little bit choppy so far. All right, so that's the euro and the pound. I do think it's perhaps a little bit of a better currency type, excuse me, currency type trade. I couldn't tell you why it seems to work better in currencies than anything else, but it does for some reason. Nice example in NASDAQ. This really took its time to come back down though. And also, when we're talking about trends, there was that flat topped wedge that I was talking about that I said we'd come back to. You get the false break, run back in, and then once you get the real break, that takes out this false break very quick. Multiple lows here, 1, 2, 3, 4, 5 lows together, so you're going to expect a quick drop. After that, you then again get this rounded move back up, which goes straight back onto those lows. Gives you a nice, at least short term, quite quick, quite tight risk trade off a nice clear area. So you can see these areas coming. You can plan this trade quite a way in advance, just knowing that the only criteria you're really looking for is you want to see quite a fast move back up to it. If you get the drift back up, then it could quite simply just drift, tick through it, and then continue to drift, and then start the move back up through this larger range. So all about that quick flick back up at the end, and something to watch out for, certainly for your quick move. And as you've seen in each of these instances though, it has then gone for a new low. So you can sort of take this trade on, nice tight risk trade, and try and run it all the way for a new low. Yes, it was difficult on this NASDAQ one because you got onside to be pulled all the way back to then go again. And that pullback there is 30s to 90s. So you're going to see a 60 handle pullback on your position before it does go, which does make that quite a tricky one. But at least for a very short term, fast money move. And that's why, for me, a lot of pullbacks to levels, I'm more inclined to take that as a quick move, sort of a quick scalp type move, particularly if it does it quickly. If I'm in more of a trend situation, then a pullback to a level, i.e. here, where we clearly moved higher, we consolidated, we broke higher, that's the kind of one that I'd be happy to sort of try and hold on to and move higher. But this aggressive drop and then whip back to a level, I think is more one to scalp, just to prevent the risk that you get the whip back and then you get the consolidation and then move up like that. So that for me is the way I play it. That's more a scalp type trade. I'm sure you get many others who would say no, that is the big one to sell, and you run it to the lows. And that's the thing with the sort of patterns technical analysis, that exactly how you want to play it is down to you. The way I try and look at things is more to do with what can I be confident is going to happen in this move, as opposed to what technically should I do with it. Because if you're 90% confident that something is going to happen, like a specific thing is going to happen, I'd prefer to take that 90% of the time than 60% of the time. Yes, it goes to the technically correct target, but I'm only getting that 60% of the time. Whereas if you can guarantee something, not quite guarantee, but have a much, much higher conviction, much, much greater sense that something's going to work, I would prefer to take that move rather than the much larger move. But that's my style. You will get other people who would say that unless you're going to hold it right the way to the move, there's no point in really taking the trade. That's, yeah, one argument versus the other there. That I do believe, yeah, wraps up candlestick patterns. Any others that you know of that you want me to talk about? Because I'm sure I've not put up every candlestick pattern that's around, or every sort of trade setup pattern that's around. But if there are any that you want me to talk through or have opinions on, I'm quite happy to get them up. No? Good. So we've got a fair few to be having a look at. What I would suggest for the rest of this week, try and focus just purely on candlesticks. Focus on candlesticks, focus on patterns, which ones work, what time frame they were, did they run all the way to target, was there a smaller target that was more consistently attainable. I think I've got a spreadsheet which I can send you to sort of try and map this out, make it a bit easier rather than you guys setting it all up. I'll find that and I will send that on to the group for you all. But yeah, focus on that side of things, on trading off candlesticks. We've got a task at the end of the week which is going to really make you think about how you take trades on based on candlesticks, based on where they close, candlestick patterns. So that will be the task for Friday. We might do it Thursday and then review it Friday. So it's a good task. Basically, you won't be out of a trade all day. So keep you focused, but keep you actually thinking about what you're doing and whether you are holding things to target. The idea of it is that you have to cut and reverse. So if you want to get out of a trade, you've got to go the other way. So it really does make you think about whether you should be getting out where you are. Forces you to hold on to trades a bit. Right, I'll find that spreadsheet and send it over to you guys either today or you'll get it tomorrow morning. So yeah, see you guys online tomorrow, and guys here, we'll have a little look at S&P, have a look at the other markets, see if something's going to happen this afternoon or if it's just going to be a very choppy range day. All right, guys, I'll leave you to I'm on the debrief later, so 4:45 if you're watching online still then. See you then, guys.